Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a tutorial on capital employed formula, and we'll be looking at few of the examples how the things work out in this particular case. So first, as you can see a tab over here, capital employed is calculated to assess the total resources employed for acquisition of profit. So how much are the resources that have been put to use for gaining the profit, for acquiring the profit? So that is the capital employed. Let's learn the formula of capital employed. See, any business needs to employ some funds, resources or capital for running the business with an intent to earn profit. That is, in anyone's case, it is intent to earn profit. This has given rise to the idea of the capital employed, which can be estimated in various ways in different contexts depending on how capital might be defined for calculation purpose. However, there are two primary ways in which it can be calculated. So we'll be writing capital employed formula number 1. I'll write FM1. Capital employed is basically capital employed is equal to your total assets less your current liability. Here, the total assets include fixed assets, at their net value. Some prefer to use original cost, but some other use replacement cost after depreciation. To this is added any cash in hand, cash at bank, bills receivable, stocks, and other current assets. Finally, all the capital investments in the business operations are added to these items to arrive at the value of the total assets in the calculation. And the next is to subtract the current liability as we have in our formula from the value arrived at the total assets. The next formula that we have in our bag is capital employed is equal to, that is CE is equal to non-current assets plus working capital. Now, this is our second formula. See, in this calculation, the non-current assets over here, this is basically equal to your long-term assets, whose full value cannot be realized within the current financial year. This typically includes like fixed assets, you can say, along with the intangible assets, brand recognition and intellectual property. So it also includes any investment made in any other business. So working capital can be defined as a quick measure of the operational efficiency of a company and its overall financial health. So we can say working capital, that is equal to your current assets less your current liability. This is the case. Okay, so now let's understand a capital employed example and let's learn things with the figures. All the figures that will be utilized for the calculation can be found on the balance sheet of the company. Now we'll be calculating first with the first formula. To calculate for the company, let's say for a company, there is a company called ABC, which is based on the first method. Okay, this is based on the first method, and we look at the figures against the total asset. Let's suppose it is close enough to 42 million, right? Next, we look at the figures against the total current liabilities. So this is your total assets, right? This is your total assets. Then we have total liabilities. If you look at the figure for the total current liability as listed in the balance sheet, let's suppose that it is close enough to 25 million. Okay, so now we calculate the total capital employed is equal to your total assets less the total liability. So that will give you your total capital employed. So capital employed using the second formula, this is the second formula we are trying to use. Calculation of the second method would require looking up for the following measures on the balance sheet of the company ABC. So non-current assets, current liability and current assets. So we can find both current assets and non-current assets listed in the assets section of the balance sheet and current liability section on the liability section. So let's suppose that the non-current assets is close enough to 105 million. And the current liability is close enough to 54 million. Now we calculate something like this. Capital employed is equal to your non-current assets, that is 105 million, right? I'll just remove million from here, just estimate that it is in million. Okay, so that will be 105 million plus the working capital, if any. So I haven't mentioned, so this is your non-current assets 105. So your current assets, current liability is 54, and I forgot to specify current assets. So if in this case current assets is 65 million, so your capital employed will be equal to 105 million, that is your non-current assets, right? You will add something over here is equal to non-current assets plus your working capital, that is your current assets, less your current liability, and this should be in bracket. Let's form this in bracket. So this will give us net working capital, right? Less the current liability. So we here will put 54, so that the final answer that we made a mistake over here. It should be E29 minus E28. So it will give us 116, right? 116 million is your final amount of capital employed, right? So now let's understand the explanation of the capital employed formula. See, capital is calculated to assess the total resources employed for the acquisition of the profit. It can be calculated in different ways, as we have described above, like, the one that we discussed. However, the basic idea remains the same. Higher the value of the capital employed, especially when a major chunk of it is not sourced from the shareholders' equity, it indicates a proportionately higher level of risk. So you can say higher level of risk is involved. Though the higher level of risk might have investors worry of investing in the company, it also hints at aggressive business expansion plan, which, if successful, could result in much higher returns as well as on the investments. So all these factors are taken into account before investing into any business. Now, what is the use and the relevance of the capital employed? Generally, it is put to good use in the estimation on how well a company might use it for the capital to enhance the profitability. This is achieved by calculating the ROCE formula. Now, ROCE is basically your earning before interest and tax, that is your operating profit, divided by the capital employed. So, EBIT is also known as we know that it is operating income, which is divided by the figure of the capital employed to get the ROCE. This is especially useful in comparing the utilization of the capital in companies operating in the capital intensive industry. Now, this is our capital employed calculator. If you put something that, let's say there are 100 million over here as assets, if you put current liability as 50, it will automatically show your capital employed as 50. If you put something, if you just change the amount to 600, your capital employed will be 550 because your liability is just 50. So let's see whatever we learn in Excel. I'll show you in terms of a template, which is very simple. In the first and the second scenario, the total assets was 42 million, total current liabilities 25. So that balance the capital employed, that is 17. That is how we just calculated. In the second case, there is non-current assets 105. The total current liability is 54 and the total current assets 65. So that is D14, that is the non-current assets, plus D16, that is the current assets, less the current liabilities. So that comes down to 116. So that's where we made a little mistake over here, 116. So it's perfect. It's fine. Whatever the calculation is perfect. So this is how the whole calculation of the capital employed is done. Thank you, everyone.